Private equity giant Blackstone is out with its fourth quarter results. Earnings and revenue beating expectations, driven by heightened deal-making activity and growth in Blackstone's data center business. The company took in over $71 billion in new capital during the quarter, with total assets under management reaching $1.27 trillion. And joining us right now to talk about the company's performance, the investing environment, AI, and much more is Jon Gray. He's the president and chief operating officer of the Blackstone Group. And Jon, welcome. It's great to see you this morning.
Great to be with you, Becky.
All right, so let's talk about these numbers. You did beat on both the bottom and the top line. And there have been a lot of talk out about whether we are seeing a bubble in the markets, whether we're seeing a bubble in AI. I'd love to get your thoughts, because data centers have been performing pretty well from your perspective, I think.
Well, we had a record quarter, a record year, which obviously makes us happy. But what I'd say is we see a number of powerful engines coming together. The first one, and it ties to your question, is the decision we made to lean into AI infrastructure. We have become the biggest investor in data centers. That has really paid off, but it goes beyond that. We become the biggest supplier of private capital to the utility industry. We're the most active investor as well in electrical equipment and related services. And we just continue to see enormous demand. The compute delivery is not keeping up with the compute demand at this point. So that has led to strong returns for our investors, which is the most important thing. The other thing I'd highlight, which you noted, is the deal environment's getting better. It really is feeling like it's hitting escape velocity. We did 4 IPOs in the second half of last year. Medline was the big one, a great family business in Chicago. The company got a great response from the public markets. And it feels to us like it did back in 2013 and 14, where we started to take a bunch of companies public after that post-GFC hibernation. And so that feels really good for us. And then the final thing I'd say is this secular movement towards alternatives from insurance companies, individuals, institutions, that continues. $71 billion of fundraising, as you noted, $239 billion for the year. So we can definitely dive deeper into AI, but the picture for us feels very good.
All right, if the deal market right now feels like 2013 to 2014, what does the AI market compare to? What time frame would you match that up against? If you're looking at strong demand now, how far out can you see in terms of that demand, and where would you place this?
I think we're still early days in this. When you think about the adoption of AI by companies, it's still very early. We're beginning to deploy it today in places like coding. Software engineers are becoming much more efficient. Cyber monitoring. We're starting to use it in the legal world at things like marketing compliance, summarization. But it's just starting in most businesses, and it's a primary push for us and our portfolio companies. What we are seeing, of course, is the need for that physical infrastructure to make it happen. I would point out, interestingly, everybody's focused on the bubble. Is this 1999? And anytime you get this kind of change, when you have electricity or when you have railroads or the internet, there's a real risk of excesses, and some of the runners in the race will not win. But I think it's a mistake to discount super intelligence at massive scale and how it will transform things. And I think the thing to focus on for investors is the risk of disruption. We've seen in the last couple of weeks, JP Morgan came out and said, we're going to replace proxy advisors with AI. We saw Lemonade come out and say, we're going to cut your rates if you use the self-driving feature by 50% on a Tesla vehicle. These are powerful. We saw in the past with yellow pages or taxi medallions, when technology shifts, there are big changes. And I think for both debt and equity investors, thinking about the risks of disruption to so many industries, what's going to happen with agentic commerce, what's going to happen in so many rules-based industries, that to us is a key field. It still feels early days for us on the adoption front.